Greetings everyone, Francis Fernando here. Hashtag how much will I make? My mantra, folks, in real estate investing, if you are a busy professional and you are busy in your daytime job, busy managing your family, and busy in overall enjoying the quality of your life, then my hashtag, how much will I make, is focused on you making sure that if you get involved in a real estate transaction, then you are going to profit from it. You will know exactly how much money that you will be able to extract from that deal. Basically, your return on investment. This is my mantra when it comes to real estate. And I'll tell you why it is so near, dear, and passionate to me. It is near, dear, and passionate to me because you take your hard-earned money and you park it in that real estate transaction when you are about to do your closing. And that money is expected to give you a return. Money is like little soldiers. They should go out there and they should work for you and give you a return on investment. Very similarly, you are also taking away your time, your very valuable time, to be able to negotiate, manage, and then ultimately own that real estate asset. So the question is, should it not make you a return, and a beneficial, significant return? And it should be calculatable. I think that's the engineering side of me. It should be calculatable. So, without further ado, I am super excited today to talk to you about the world of finance, the world of money. And our topic today is, how does the whole mortgage industry work? What can you do to present yourself better to the bank that is ultimately going to lend you the money to buy your investment property? How can you make yourself look attractive? For us to understand how the world of finance works as it pertains to mortgages, we've got to understand and we've got to dive in a little bit into their world. I call it the primal instincts. Every business has a primal instinct. I'll be sorry to tell you guys, I am so sorry to tell you this, but everyone looks out for themselves. Everyone and every business looks out for themselves. So ultimately, no matter what business you decide to partner with, they are going to be in it for themselves. So today, we are going to dive a little bit into the mortgage industry and see what their primal instincts are. How do they make money? And once we start understanding what makes them tick and what makes them flow, then we can better position ourselves to present ourselves in a way that we can get the best possible mortgage. First of all, get qualified, get the best possible terms, and understand where to position ourselves so we look attractive in the eyes of a lender. Because the other thing I want to tell you is, a lender relationship or a lender agreement is based heavily on relationships. So it's also understanding their primal instinct from the standpoint of making and creating a relationship. So that's what we're going to get into. So I'm going to take it back to the basics. And if you understand, let's go to the basics of, you've evaluated a property. So you're looking at you're a full-time employee. You've done all your analysis as it pertains to how much this property is going to generate for you. So hashtag, how much will I make? You have focused on that. You've done your pro forma analysis, and you know what your cash on cash return is. You know what your ROI, you know what your cap rates, all of the important ratios as it pertains to real estate investing. You've got that down. right? And if you have read the book Job plus Real Estate Equals Wealth, again, if you've read the book Job plus Real Estate Equals Wealth, you will know that one of the things that I recommend, or one of the strategies that I highly recommend in that book, is to make sure that you have your success team already lined up. One of those success team members is your lender. Make sure that your lender is pre-lined up, right? So now you're going to take that purchase along with your pro forma and you're going to present it to the bank. And here is what happens from the time it hits the eyes of the bank. Here's what sort of internally works. So the bank is called the mortgage originator. These are the first people, these are the customer facing, the consumer facing people. They are called the mortgage originator. So the number one person that is transacting with you is the mortgage originator. That mortgage originator can be in the form of a retail bank, like a Bank of America. They could be a mortgage bank, right? A mortgage banker like a Wells Fargo, for example. Or they could be a real estate broker, either a commercial or residential broker. Now we're speaking investment real estate, so it's typically going to be a commercial real estate mortgage broker. And those could be, there's several thousands of mortgage brokers in the country, several tens of thousands of mortgage brokers. So a mortgage broker is basically someone who will take the application and look at multiple different retail or mortgage outlets to mortgage bankers to place that loan with. So that's called a mortgage originator. The way a mortgage originator works is they are going to take your application. Now, when it's investment grade real estate, they're doing two things. And this is a write me downer. This is an important item here. When it's a commercial mortgage, when it's a mortgage involved in investment real estate, unlike a traditional residential mortgage, they are not only going to emphasize on you as the borrower heavily. Typically, when you're buying a home or a condo for yourself, yes, they are going to look at the property. Yes, they are going to, in terms of an appraisal, they're going to look at the property. But when and they're going to put a heavy emphasis on you when it's a residential purchase. So a lot of emphasis on you as the borrower, little bit of emphasis on the property, mostly in terms of an appraisal. When it's investment grade real estate, they look at both. So it's almost flipped around. They're going to pay a little emphasis on you, so a small amount of emphasis on you as a borrower. So your credit report, your experience, your history, your asset allocations, what you own, your debt obligations. They're going to pay a little bit of emphasis on that, but they're going to pay a heavy emphasis on the property. And this is why I so push the understanding of what's called a pro forma or property analysis tool. Do your numbers so that you understand how that property is going to perform. So the bank is going to pay a heavy amount of emphasis on that. And that's sort of how they determine the risk reward. Right? And so the mortgage originator, so we're back to what the mortgage originator does. That's the customer facing. So you're going to present your asset to the mortgage originator. The mortgage originator, again, is going to place a little bit of emphasis on you, a lot of emphasis on the property. If it underwrites and it passes an underwriting, you've gone through your mortgage application, you're typically going to be paying a fee, a loan origination fee. That's typically how the mortgage originator makes money. And then you're going to get an interest rate. Right? It goes through several different steps. Once it goes through, mostly it's called loan origination, and then it goes through underwriting. Underwriting is basically a group of bankers will sit in a room and evaluate your loan and look at the risk tolerance of your loan. And I'm going to talk to you about a specific ratio that they're going to look at. But they're going to underwrite that loan and determine if it's a yay or nay. Are they going to extend you the loan terms based on the loan application? If it's accepted, if that loan is accepted, you're going to get a term sheet which has interest rates and the terms of the loan. So now we're back to the mortgage world. So that's the mortgage originator. As soon as they give you that mortgage rate, that mortgage is then going to be, once it's closed and you've closed on the property, if you've noticed, a lot of times you'll close on a property and a servicer you might get a letter from the servicer being the person who is collecting your mortgage payment. You might get a letter from the servicer saying that the mortgage has been sold. If you've got that, here's what's going on. And here's what happens all the time. That mortgage originator is aggregating all these loans, your mortgage and other people's mortgages, and they're selling it to the secondary mortgage market. So the second person in the mortgage world is the secondary mortgage market. I will give you two names of outfits that are involved in the secondary market because that's going to ring a bell to you. It's Fannie Mae and Freddie Mac. These are typically government-backed entities that will pick up and purchase these mortgages. So these mortgages are aggregated by the loan originator or the mortgage originator, sold to the secondary mortgage market. They are known as the aggregators. So they take all these mortgages. Now, Fannie Mae and Freddie Mac will also originate their own loans. So not only are they going to be having their own loans and servicing their own loans, but they'll also get these loans from all these originators, so the mortgage originators. These loans are then converted based on the quality of these loans and based on the terms of these loans. These loans are then converted into what's called mortgage-backed securities. Now, one quick item before I get into that. The mortgage originator, the first person on the step, makes money by as I mentioned to you, the fees that they charge you, so a loan origination fee. And these are all justified fees because everyone has to make money. So loan origination fees, there's typically some fees that they're going to make. They're also going to make some money on the yield spread between what the interest rate they charged you versus the interest rate that they sold the mortgage to the secondary mortgage market for. So quick example, you lock in with the mortgage originator at 4%. But the loan is sold to the secondary mortgage market for 4.25%. That yield spread of 0.25% is paid to on a monthly basis, but mostly in aggregate terms, is sold back to the mortgage originator, and that's how they make their money. Now, it's very important. I'm going to make a statement here, and really it's going to be the theme of how we tie it in at the end. The quality of those loans that are sold to the secondary mortgage market is so critical. And when I mean the quality of those loans, I mean the quality of the borrower, the quality of the asset, the longevity of the loan, how long the loan lasts and stays within the servicing, are they refining constantly, and also the default rate. So there's many things that go into the quality of the loan, but the quality of the loan is a very important measure. Now, once it hits the secondary market, like I said, Fannie Mae, Freddie Mac, they are going to aggregate these loans and they're going to internally convert these into what's called mortgage-backed securities, MBS, mortgage-backed securities. These mortgage-backed securities are then sold to the third line down the chain in the mortgage world, and that is the securities dealer. So the securities dealer, right, your Wall Street firms, they are going to buy these mortgage-backed securities, and they are such creative people. What they're going to do is they're going to chop that mortgage-backed securities into, I love these terms here, so I've written them down. They are called CMOs, ABSs, and CDOs. I'll tell you what they are. CMO is a collateralized mortgage obligation. An ABS is an asset-backed security, and a CDO is a collateralized debt obligation. These are basically products. These are basically investment grade products. So this mortgage-backed security, which in itself is a investment grade product, is then either kept as its original mortgage-backed security, or it's split up into these CMOs, ABSs, and CDOs. Again, CMO, collateralized mortgage obligation; ABS, asset-based security; and CDOs, collateralized debt obligations. They are split up, sold into those based on quality and based on return on investment. Okay, so that's number three. That's the third person down the line. Those products are then ultimately invested in by investors. That's the fourth person, investors. The fourth person down the chain from the time of origination of a mortgage is the investor. The investor is in terms of, we're talking large institutional lenders that buy mortgage-backed securities, that are buying investment grade backed by real estate holdings. Pension funds, insurance companies, foreign banks. These are typical examples of people that are going to invest in these kind of products. So that's really how in a nutshell, that's really how the mortgage world works. And it's important to understand that when you apply for a mortgage, or when you're negotiating a mortgage, it's not going to remain in the four walls of the room that you are negotiating that mortgage. It's moving on, and it's being sold and sold and sold. And as we have pointed out, it's being sold 4 times. So let me start over just to summarize. The mortgage originator is the first person. That's the person you meet. It's then sold to the secondary mortgage market. That's the Fannie Mae's and the Freddie Mac's. It then goes and it's securitized, and it's sold into to a securities dealer, a Wall Street type securities dealer, and then ultimately an investor is investing in that institutional grade product. Now, why am I sharing all this, and why is this important? Why is this important conceptually to you? Somewhere down in the episode today, I talked to you about I used the term quality, the quality of the mortgage product that is being sold. That is a common theme and a common thread that flows throughout these four entities that are involved in the mortgage. Mortgage originator evaluates the quality and then sells it down to the secondary mortgage market. The secondary mortgage market evaluates the quality, sells it down securitizes it, and sells it to the securities dealer. The securities dealer then chops it up, evaluates the quality of it, breaks it up into different components, and sells it for a yield-basing product, investment grade product. Throughout those transactions, the quality is so important because performance is tied to default rates, is tied to longevity of the loans. And so those are measurements that are then going to allow each of those entities to measure each other. So in other words, if that loan ultimately fails, they extend that loan ultimately fails, it becomes a non-performing loan, then ultimately all the way at the other end of the chain, the investor who invested in that product is going to suffer the consequences. It's then going to flow in a reverse backstream where all the entities involved with it will evaluate the quality of that loan. They'll start digging into the papers and understanding that, hey, we were sold a bad product, and it just creates a reputation issue. So herein lies the point of this entire episode, is that the quality of the loan product, the quality of the asset, the quality of the individual is of utmost importance. So when you are presenting yourself to pick up or apply for a mortgage, You want to make sure that you are presenting a product that the bank, the loan originator or the mortgage originator in your case, knows that it's a quality product. When they know it's a quality product or a quality person involved in the product, then they are that much more apt to give you better terms. And so it's so important to understand that. Now, I want to tie that in and sort of close this with, well, answer the question, well, how do you then, Francis, present yourself with a quality product? Do you take great pictures of the property and show the mortgage originator? No, you don't do that. Here's what you do. You focus on a couple of important ratios, and it's all tied into the pro forma. It is very important to, again, do your analysis on the numbers, but there's one ratio and one ratio only that the bank really pays attention to. It is called the debt service coverage ratio. And for your benefit here, I have stated it here. Again, debt service coverage ratio, also known as DSCR. Debt service coverage ratio is your net operating income divided by your debt service or your mortgage payments. Again, net operating income divided by your mortgage payments. And the ratio, the number that's important that most lenders are looking for is a 1.25. Now, I'll explain what the 1.25 is. That is saying that 25% more cash is being generated from an NOI perspective, 25% more than is required to service the debt. So 1.25 says 25% more. That's the minimum that most banks are looking for. The higher, the better. So let's just say it's a 2.0 or a 1.5. Let's use a 1.5. If it's a 1.5, it says that the property is generating 50, from an NOI perspective, that's all after all expenses paid, 50% more income than is needed to pay the debt. So it's a healthy building. The bank feels like they're in a secure position. Now, let's say it's a 1.0. Your debt service coverage ratio, again, defined as debt service, as net operating income divided by debt service. Let's say that it's a 1.0. Now, the bank is going to be nervous in a 1.0 scenario because that tells the bank that every dollar that is generated and from an NOI perspective, that is all expenses paid, every dollar that is generated has to go in to service the debt. The fear with the lender in this instance is that every single dollar that's generated is used to pay the mortgage. There is no cushion and there's no ability for any kind of unforeseen circumstances to be funded because there's not enough cash being generated. So that's really important. I'm going to leave you with a quick thought-provoking idea or a thought-provoking challenge. If you are looking at a building and the building has a debt service coverage ratio less than what the bank is comfortable with, like I said, most banks, not all, but most institutional lenders or most mortgage originators are looking for a 1.25, right? That's pretty average. Let's say you do your numbers and the building is coming out at a 1.1. So it's significantly less than a 1.25. What would you do? Would you still purchase that asset? My response to that is possibly. I have purchased several assets below a 1.25. Now here's what I do. When I know there's potential and I've investigated what is going on with the building, I'll give you a quick example. Let's say the building has been owned by the same entity for multiple years. And because they've owned it for multiple years, they haven't raised the rents. So the revenue side of it is basically under market value. On top of that, I'm making up a hypothetical scenario here. On top of that, they haven't improved the condition of the units that justifies a significant rental raise to bring it up to market. What I would do is run my numbers, and to me, this is huge potential. I'm able to negotiate strong on a purchase like that because it's below the 1.25 with the seller and say, listen, I need to get this property at a really significant discount. That in itself is going to help your debt service coverage ratio, but you can also go to the lender and say, listen, based on my experience, this is a 1.1 because of these factors, and you show them and you demonstrate proof to them that, you know, rents are below market value. And also there's capital improvements that need to be done in the units to be able to raise it significantly above. And by making those changes, making those value adds, you're going to take that building from a 1.1 to a 1.75. You're going to create an extremely valuable asset. That's my challenge to you. Look for the buildings that have a debt service that is not as attractive, but where you can do the value add. Then you present that to the bank in a way that displays your experience, your keen eye for business, your keen eye for creating a greater NOI and creating a stronger position where the bank feels that they're in a secure position. At the end of the day, it is a partnership. Your lender is a partner with you, and you should view it in that way and not view it as far as it's a adversarial relationship. It's a partnership, and you want to win, but so does the bank. So with that, folks, I hope this was of value to you. In fact, I know this was of value to you. Connect with me if you would like to learn more about the other ratios that banks look at. But for the purposes of the mortgage world, a bank is extremely, extremely focused on the debt service coverage ratio. Take care, happy investing, and remember, a debt service coverage ratio of greater than 1.25 is your goal, and if you can get it below 1.25, then you demonstrate to the bank that you, with your value add, you can take it significantly above a 1.25. Take care. Happy real estate investing.